Good day, viewers. Once more, I welcome you to our channel. All right, please have your seats and have your writing materials with you, of course, as usual. Please make sure you have your writing materials to put out some things, some interesting updates I will give you, or analysis I will give, or examples I will give. Right, that interest you, please take it down for reference, and to also make sure that you check up yourself with our ExamGuide app for questions and answers. All right, so let's go ahead. So today we're looking at a topic titled Balance of Trade BOT and Balance of Payment BOP. All right, so let's go. So we're going to define balance of payment, differentiate between the balance of payment and balance of trade, state reasons for imposing tariffs or restrictions in foreign trade. This is an area of concentration now. Now, what is balance of trade? In this case, we talk about the visible items, all right? Balance of trade involves visible items, goods that are traded. This is not service as well, all right? So it depends on what? On visible items. So it's a relationship between a country's total value for all her exports, visible export, and the total value for all her visible import from other countries. This is what we call what? Balance of trade. When you compare these values of goods, right? Total volume of goods exported and that of imports, you can now say you are looking at the what? Balance of trade items. So it has to be visible items, okay? Because you're talking about goods, not services here, right? Whatever you import that is tangible and visible, it talks about what? Trade. In this case, visible. So when you talk about the balance of trade, you're looking at visible items. The amount that is imported and the amount that is exported, the relationship between them is what we call what? Balance of trade. So you can see here, when you have visible export being equal to visible import, you have what? A balance of trade. But when they are not equal, you have what? A disequilibrium. Sometimes it's called unfavorable. The other time it's called what? Favorable. So when it's not equal, you can have it as favorable balance of trade or unfavorable balance of what? Trade. So that means if it is favorable, it means that the country in question has enjoyed more trade differences between him and the country in consideration. All right, so if the reverse is the case, it means that the country is suffering from what? A loss in trade compared to the country they are trading with. So yes, that's what we call this equilibrium. Okay, thank you. So now we have favorable BOP. Let's look at it. A country has favorable balance of trade, if it has a positive balance of trade. That is, when visible trade is what? Greater than what? Visible import. When your import is less than what? Your export, in this case, you have what? A favorable balance of trade activity, all right? So you look at it, whenever you have a higher advantage of volume of trade compared to your counterpart country, it means what? You are enjoying a favorable balance of trade. That is, your visible export exceeds what? Your visible import. Then the unfavorable one is what? A country is said to have unfavorable balance of trade or negative balance of trade when her visible export is less than what? Her visible import. In this case, you are at a disadvantage, you are at a loss, all right? When compared to your counterpart in trade, you are at a loss. So that's what we call unfavorable balance of trade, okay? So yeah, just like the judge or the courts environment, you check, you weigh and balance, right? So this is me to tell you that yes, there's a check and balance between these two things. You know, okay, are you at advantage, or you are equal, or you are at disadvantage? So yes. Now we look at the other part of our consideration, balance of payment. What is the balance of payment? It's a systematic record of all economic transactions that take place within one country and the rest of the world over a given. Now, this is one. There's another way you can also define this thing, all right? You can call it what? The difference between the total receipt of a country's export value of goods and services and the total payments of a country's imported goods and services over a period of time. So this difference or this relationship explains what? Balance of payment. In this case, you're talking about both visible and what? Invisible items. When you put them together, the amount you earn for exporting visible and invisible items to other countries and the amount you pay for importing visible and invisible items put together tells you the balance of payment. You can have it as favorable or what? Unfavorable. You can surplus or deficit, all right? So whichever one term you want to use, you can go the same way. So now we'll have what? Balance of payment, which is what? The relationship between a country's total receipt for our exports and payment for our what? Imports. That's what we call balance of what? Payment. So take that down. We have two types. One is what? Favorable or surplus. All right? I call it favorable or surplus balance of payment. If a country's total receipt for all her exports from other countries is greater than what he pays for imports, you have what? Favorable or surplus balance of payment. In this case, total export value exceeds what? Total import value in monetary terms, okay? That's what it means, all right? Then unfavorable balance of payment also involves or refers to what? A country's BOP, when it is deficit or unfavorable, is when your total receipt for exports is less than what? Your total payment for her exports. That means you have unfavorable balance of what? Payment. In this case, you're at a loss. That is, the value of all your exports in monetary terms is less than the value of all your imports in monetary terms. So you are at a disadvantage in this case, right? So you have what is called a deficit or an unfavorable balance of what? Payment. When it is balanced, you have what? A balanced BOP. That is, total export is what? Equal to total import. In this case, you are even, all right? So a country's BOP is said to be balanced or at equilibrium when her exports receipts is equal to our import payment, all right? Yes, that's what we mean by a balance of payment that is balanced, okay? So have the components of balance of payment. There are three components in balance of payment, all right? Number one is what? Current accounts. Number two is what? Capital account. And the third one is what? Monetary movement accounts. Okay, let's look at this individually. The current account. How is the current account important in balance of payment activities? This account contains the total receipts, that is income for a country's total exports and total payment for all imports. All right? That is what happens recurrently, all right, every now and then, repeatedly. You buy and sell, you buy and sell, you buy and sell, all right? The records that are kept in what? In the current account, okay? That's what it means, okay? So that's where we keep the accounts or records for imports and exports. Capital account. This account is made up of capital inflows and outflows, right? Capital inflows and outflows. What are outflows here? Outflows involves movement of capital in form of loans, grants, and investment from other countries, right? And what are inflows? These are movement of capital in form of loans, grants, and investments to other countries. All right? Inflows are what? What comes into the country from other countries, while outflows what goes to other countries from a country. So when you move capital from one country to another country, it's an outflow. When you bring in capital from other countries into a country, it's called what? An inflow. So what we have there should be inflows and what? Outflows. So we have capital inflow and capital outflow. So the first one is capital inflow, and the second one is what? Capital outflow. All right. So when it's inflow, when it means that there's movement into a country of capital in form of loans, grants, and investments from other countries. There's capital outflow from one country to another when there's movement of capital in form of large amount of loans and grants and investments to other countries. Now the monetary movement account is used to show the balance on both current and capital accounts and how it is settled. All right, how both a current account is settled is shown in monetary movement accounts. Okay, that's how to know. Now it shows how the surplus or deficit on both accounts are settled. When you have surplus in monetary in a current account, or you have deficit in current capital account, how are they settled? This is it shows a summary of movement of money from one account to the other, or from one level to the other. This is what the monetary movement account tells us. It gives us a summary of how accounts are settled or balanced over time. Okay, so why would a country try to protect its trade against others? That is, we're looking at reasons for trade protection or restrictions on foreign trade. Why would a country want to engage in trade restrictions? Okay. Now, number one is to ensure that infant industries are protected, to ensure that these new and budding firms don't die off because of foreign competition. They invoke these restrictions to ensure that there's healthy ground for competition between the local infant industries and foreign products, because these same products can come in and dissuade local consumers from buying the local products because of maybe how quality they are compared to local ones. Of course, that's the truth. So restrictions can actually be used to reduce the inflow of foreign products into a country, just to help the new and budding firms in the country that produce similar products in the country. So yes, that's one of the reasons. The number two there, government to generate revenue. All right. You can also help government to generate revenue by using taxes, that is talking about tariffs. All right. Using tariffs to generate money for the government by imposing tariffs on imported and exported goods. If that is done, all right, the government can generate enough money to run some other programs in the country. So it also helps to prevent dumping. Remember, I've talked about dumping in the previous lesson. What is dumping? The act of selling goods to foreign market are below the cost market price, or the cost price in the local country of exports. So yes, that prevents dumping. So when you invoke restrictions or practice restriction of trade, it can help you reduce dumping or even prevent it from happening in your own country, because products become more expensive in the local market. All right, that's what it is. Then to improve the country's BOP deficit. When a country suffers BOP deficit, it is very important or necessary or mandatory for it to engage trade restrictions. All right, which will actually reduce the inflow of trade from other countries to your country. That means you have to reduce how much you import. All right, that's a very good reason why a country should engage in restriction of trade. Then, as a retaliatory measure, as a country, you might want to retaliate from what other countries have done to you, because, of course, recently, Mr. Donald Trump has been, orally and even officially increasing tariffs for some countries. Okay, by even making an outright ban for some countries' goods from coming to the country. And again, in a like manner, some other countries also retaliated and take similar steps to also ban or increase tariff for their own products. So yes, in such a case, we'll call it a retaliatory measure in trade activities. Okay, also to prevent importation of dangerous goods. Remember, we'll talk about one of the problems of international trade. You talk about importation of dangerous goods or harmful goods. Now, for that to happen, all right, you do what? You can actually use restrictions, all right, in trade to prevent such goods from coming in, right? But looking at them and actually going for them and restricting their transactions by using some kind of preventive measure, or maybe outright ban, all right, to such goods can be used as what? Trade restriction. All right, you have to promote self-reliance. Some countries can also become self-reliant if they can actually properly manage trade between them and other countries. So to do that, you might actually need to engage some level of restrictions in trade that will actually embolden the country to grow on its own and have more self-reliance than depend on other countries for what they consume or use. All right, so to check consumption pattern. Of course, governments want to reduce how people buy foreign goods, all right? How they engage in use of foreign goods. For that reason, they may also want to use restrictions on such a consumption pattern of foreign goods, right? To make it more locally consumed, or consumption of more locally produced goods. Such a case can be the reason why government may engage in restriction of trade. Then, to protect strategic industries. If you allow competition to happen in such industries, it might actually, all right, reduce the economic growth or potential of the country. All right. There are some protections there are some goods that should not be allowed to enter a country because it is locally manufactured and it's enough to supply the country. So such a case, such industries that are strategic for the growth of a nation and stability of a nation should not be allowed to face competition. All right. So in such a case, a government can go into what? Trade restriction practices. All right. You have to create employment in the country because, of course, when you keep importing, you have actually indirectly exported job opportunities from the countries to other countries. So such a thing that can be produced in a country being imported is an indirect way of what? Exporting jobs. So when you have restrictions in trade and those goods are produced locally, you have actually improved employment and then saved employment for the country instead of exporting them by importing more goods. All right. Yes, of course, for political reasons, like Donald Trump has, all right, mentioned restrictions. Some other country presidents also wake up and say yes, like Burkina Faso also banned some countries, some products from the USA, or also reduced or increased some tariff of some USA-made products too. So that's what political reasons to show that also they are also politically viable or responsible. So that can be one of the reasons why restriction can be used in international trade. Some tools that can be used in these restrictions of international trade. All right, let's look at some of those tools that can be used to restrict trade. This is not exhaustive, all right, but we can actually use this to explain more. We have what is called import duties or tariffs. These are taxes that are levied on goods that are coming and out of the country. All right, these are taxes on goods that are imported or exported in a country. All right, so those are the things that can. So when they are higher, when the government increases such tariffs or tax, it actually restricts how much volume of goods or trade that come into the country or goes out as well. It reduces the volume of trade because it becomes more expensive to trade when the tariffs are high. All right, so trade will be reduced. Foreign exchange controls, another one. This is a form of restricting currency exchange by the government, all right, to unapproved entities, all right, or setting fixed exchange rates to control currency value, as well as limiting the amount of currency that can be imported or exported. All right. So this requires foreign currency earning to be sold to the central bank. So some of the time, the government will only want central banks to be able to buy foreign currencies and then distribute it adequately so that it can control foreign exchange value over time. Okay. We also have devaluation as a tool. What is devaluation? These are actually the act of the government to reduce the country's currency value in the international market so that when it compares to other currency, it is lesser in value. So that's what it means, an act of the government to consciously devalue its currency. This, in this case, is aimed at increasing exportation. But when a country doesn't have what to export and you devalue your currency, you're actually hitting yourself on the foot. So yes, one of the tools to instruments of trade restriction is what? Devaluation of currency, because when you devalue, you sell more and import less. In such a case, you have actually restricted importation. All right? Then you have embargo. This is outright ban of trade on some goods or services. When the government places an embargo on some goods, it means that nobody in that country is allowed to trade on such a product or service. So that's an embargo. It means that outright ban of trade in such a product or service. Then you have import monopoly, whereby the government of a country allows only an entity to be the sole importer of some kind of products. In this case, NNPC is the only one that is allowed to import finished fuel products, all right? And that's it. I think also to explore oil directly from source, all right? So that's what NNPC is allowed to. So that's what we call import monopoly. Then import quota as well is another tool that is used by the government to restrict trade. That is, a proportion of import will be allowed or allotted to an importer or for a particular product. That when that quota is exhausted, such a trade in such a product will be stopped until the next business year starts. All right. So, for example, if the Nigerian market requires 1 million bag of rice in a year, all right, and they said only about 30% of that proportion of rice will be imported. So whenever they have imported 300,000, I think, yeah, 300,000 quantity of bags of rice, importation of rice will stop until the Nigerian market is able to supply 700,000 bags of rice before a new quota will be given. So yes, that's what we mean by quota. Then you have preferential duties, all right? Some goods or dealers or importers are giving some preferential duties just to enable them to trade, and some are giving much more higher duties to stop them from trading. So these are preferential duties are also a means of restricting trade. When the duties are high, it stops trade from happening or reduces the amount of trade that can take place. But when the duties are reduced, it encourages more volume of trade to take place. So whichever way the government wants to use it, all right, it can also encourage or discourage trade based on how it is applied. Okay, so yes, that's one by preferential duties. The excise duties reduction. So yes, when government wants more export to take place, what will they do? They can reduce excise duties so that they can encourage more production in the country, so that they can increase the potentials of exporting those goods into other countries. So yes, they can use reduction in excise duties so that the goods that are manufactured locally can be improved and increased as well. We have import license. This government uses to restrict the overall importation markets, all right, to some selected persons who are qualified, seem to be qualified, all right, and are approved to do imports. So when such a license is not given to you, you're not eligible to import such a product, and if that is discovered you can be arrested and prosecuted. So yes, you don't have a license to import some medicine or medical equipment, you cannot import it. Some laboratory equipment, you cannot import it. Some security equipment, you cannot import it. So right, so that's how some goods need to be given, or some sellers need to be given import license for them to import. If not, you're not allowed to do so, because if you do, you'll be arrested and prosecuted. Then remedy for deficit or adverse BOP. When you have adverse BOP, how do you manage it? How do you remedy it as a country? Let's look at it. When you have adverse BOP, what do? You are advised or encouraged to increase tariffs to discourage more imports. When you increase tariff of the goods being imported, it becomes much more difficult to import it, or more expensive to import it. Then you can also devalue your local currency, okay? When you do that, you can actually do more exports than imports. That can also help you to increase your BOP value, all right? Again, okay, another remedy for deficit BOP, all right, is borrowing from IMF. Of course, IMF was established to help countries after the Second World War to be able to correct their balance of payments deficit issues, all right? So they give money to countries to engage in trade, to buy and sell, so that they can actually improve in their earnings, all right, to correct adverse balance of payments. So that's why they are established. So you need to borrow from such a place or institution, so that you can actually help your country to trade more, all right, maybe to produce and trade, all right? So yes. Then establishment and promotion of import substitution industries by a country can help it address BOP deficits. All right? That is, you want to improve productivity in your country for those goods that are being imported. You want to help industries to substitute by producing what is imported within your country locally. When that is done, it's one of the ways to remedy BOP deficit. All right? By ensuring that what is being imported is produced locally. Then again, sales of foreign investment and assets. If you have investment across those countries that are actually taking advantage of you, you may be advised to sell it off so that you can retrieve your money from there and bring it back home. All right, and by so doing, you can count that as export too. So you can increase your earning from such a country by selling off your assets with them and earn more from it. Okay. Yes, of course, that's one of the ways you can actually remedy BOP. Not the only way, of course, we have export promotion by encouraging traders to be more export-minded and export-active than not, all right? When that is done, you can actually improve the amount of export that takes place so that it can be comparable to the amount of import that also happens, all right? Without any tariff increase, you can actually use this one to balance your BOP deficit, when you encourage more export activities than importation activities. All right, that can help you remedy your BOP deficit. All right, increase in domestic production of goods. Of course, that's one of the things that you must do. All right, get industrialized and improve productivity. Okay, when you increase local production of goods, either for exportation or for local consumption, it will reduce import of those goods as well. All right, so there should be increase in domestic production of these goods, either the ones that are imported or the ones that are not imported, but that to help what, to reduce the need for imports. All right, yes. Then you have apply restrictive measures such as import quota, that is giving proportion to importing of certain goods that are being produced locally to reduce the amount of import of such a goods and then produce locally. Again, you can also use import licensing, all right, to monitor how much is imported through a specific importers. All right. Okay, so let's check off some questions that will help us understand more and update what we've learned from the video lesson. So let's look at these questions. Number one here says the ratio between a country's exports and her import price is the what? Is what? Is terms of trade. Please take note of that. Terms of trade. Okay? When a country's total visible and invisible exports are more than its visible and invisible import, it has what? It has a favorable balance of payments. Please take note of that. Okay? Then the relationship between all imports and exports of a country is known as, between all imports and exports of a country is known as balance of payments. Okay? All imports, all right? That's visible and invisible, okay? Yes, balance of payments. Then an unfavorable balance of trade for a country means that her exports exceed import. No. Visible imports exceed visible exports. Yes, that's the answer. Okay, thank you. The difference between a country's imports and export of goods in a particular year is balance of trade. Okay, balance of trade. A country's balance of trade of minus 20 million shows that its import volume is greater than exports. Import and export volume are equal. Import and volume is greater. Okay, our answer is A. Okay, so the next question is, terms of trade refers to what? The agreement between two trading countries. No. Conditions attached to specific trade. No. The relationship between export and import price of a country. That's correct. Okay, let's look at this one. The rate at which a country's import exchange to its export is what? Terms of trade. Okay. Now, which of the following is classified as invisible item in balance of payment? Anything that is service-based is what? Is invisible. So we talk about import of goods, salaries of expatriates, import of granules, sales of equipment. So is what? B. The last question we're going to look at here is this. Which of the following is not used to correct an adverse balance of payment? Increase in imports, increase in export, decrease in imports, devaluation. So R is what? Increase in import is our answer. So thank you very much for your time. So great to have you around. So please make sure you look at more questions in the ExamGuide app to increase your proficiency in what you've learned. God bless you.